Hey guys, this is Investor Blue Book. Today I want to talk about a company called FSLY. Trades on the New York Stock Exchange. Ticker is FSLY. You may have heard of it recently as it had a huge 30% correction due to a change in revenue guidance for the most recent quarter. But this is one of the popular fast-growing cloud stocks. I'm invested in it. I want to talk a little bit about it, look at the business model. A lot of these business to business SaaS cloud type stocks are difficult for most consumers to understand. If you're not, if you don't work in IT, if you're not technical, you're unlikely to use this, directly at work. But a lot of websites that you may use as a consumer use this as part of their distribution system to get their content to you. So I'll talk a little bit about it, and I think going through this investor presentation that they have on their website will be a good resource so we can learn more about the company and some basic things about it. It was founded in 2011 and it IPO'd in 2015, based in San Francisco. And Fastly operates a edge cloud platform for processing, serving, and securing applications. And edge cloud software is used to decentralize processing power to the edges of networks. So that's client devices that you and I have, phones, tablets, etc. They're otherwise known as a content delivery network, a CDN, which is a network of servers in various locations around the world. When someone connects to a website that uses a CDN, it figures out what server is closest to the location to the user and serves assets from that location. And it helps page load times improve because the assets have shorter distance to travel. So a lot of content delivery, e-commerce, video streaming companies will use a service like Fastly, like Cloudflare, like Akamai to help get their content to users. But let's just go through this investor presentation from August to learn more about it. So they have their own brief intro. Who is Fastly? Fastly provides developers with a secure and programmable edge cloud platform, as I mentioned. So it's a tool used by developers in their apps. So Fastly momentum at a glance, IPO about a year and a half ago, and very strong revenue growth. It is a growth stock. It's not profitable. Looks like they have a lot of revenue coming from enterprise, which makes sense. Looks like they have a strong retention rate, and it's growing. So this company is all about growth. It's all about enterprise, which is an attractive segment of the market right now. And what is this? The modern internet has new requirements. So digital transformation, applications built but not brought, new architecture, and operational efficiency. So it just shows how Fastly is kind of built into the work stream in the technical stack, and how the advent of this kind of service has been uplifted because of COVID, and a lot of digital transformation is going on for enterprises that have way more bandwidth to cover now that everyone's working from home and relying on the internet infrastructure more and more. So this is where a company like Fastly has caught a huge windfall and directly benefited. So this is how you might be familiar with Fastly. These are partners and clients of Fastly that use their services. These are kind of web-based services and some technical tools. But most of you probably use Reddit. Maybe everyone uses Google. You shop on Etsy, Wayfair, Pinterest, Slack, Wealthfront. So on the back end, they're all using Cloudflare and their edge cloud platform to deliver their content, their services to you without any latency, without any lag. It helps their applications run smoother for the end user and compute the processing in a more efficient way with faster load times. And this is a good example of that. FSLY's model is in the bottom, their edge cloud system as opposed to the legacy system. And you can see they highlight the whole workflow from server to edge to the edge compute or your device. It's all through the developer control. So this is a tool that's built for developers that they can program into their applications to get data from their server directly to users. Versus in the legacy system, there's a whole process of IT with load balance appliance. I think it's web application, firewall, appliance, bot, and distributed denial of service, and an edge router. So this is more, Fastly has a more seamless integration that developers can use to deliver content. They have different edge clouds in different parts of the world that are able to deliver data more efficiently to end users. And here's a map of their global network. These are their hubs where they distribute the data, where they have their servers. So it's a global network, 100 terabytes per second in 55 markets, with a couple new markets, looks like in the Midwest. And here they highlight some of their competitive differences. A programmable edge. Like I said, this is a tool, like we saw a few slides ago, it's just a tool used by developers. Doesn't require as much IT overhead to implement. Software-defined modern network, safety in depth, and customer empowerment philosophy. So this is a tool for developers. And here they kind of highlight some of their competitive advantages that they have over other legacy content distribution networks, centralized clouds, and small business CDNs. And they highlight, again, the enterprise growth. So year-over-year revenue, year-over-year revenue is primarily enterprise, which you can see is good. It's kind of recurring revenue, it's a usage-based revenue model, but it's consistently growing every year with large enterprise clients, so that's good. I guess the client base is more stable, and you can see that they're generating an average of 500,000 to 700,000 per customer, and their customer usage, a lot of it is in the expansion phase. So with edge compute and security, the opportunity to build applications at edge to improve digital experiences for their customers and desire integrated security. So it seems like they have strong growth in their revenue model as businesses rely more on cloud services to serve their customers. And as I touched on earlier, they have very strong retention rate, 99% revenue retention rate, pretty good. It's a growth stock, so that's kind of primarily what it's valued on. And how they grow, land and expand, moving into new verticals, platform integration, platform expansion, leverage partners such as Google, Microsoft, AWS, and international vertical expansion. You saw on the map, I think they're in over 50 markets worldwide. And here we dig a little bit into their finances. So right there, they highlight what you're buying: strong top line revenue growth, That's the most important thing with these kind of stocks. Expanding gross margins, significant operating leverage, and a disciplined path to profitability. I don't believe Fastly is profitable yet, but that's what they're aiming for, and we'll probably talk about their progress towards that plan. So here they're talking about the total addressable market for edge computing and other services they offer, about $35 billion, with roughly half of that coming from the CDN and streaming business, the other half coming from app services and security at the edge. And this is a growing market as well. And here we can look at their revenue growth, 45% compound annual growth rate, very strong. So that's quarter over quarter. And their annual revenue growth of around 40%. So that's a strong trend that a lot of investors are looking for with this stock. And they have their gross margins, so this is their revenue minus their cost of goods sold, around 60% yield. And so they highlight their levers. Future state should see bandwidth as largest contributor to cost of revenue. People/co-location expected to grow at a slower rate than bandwidth, and increased peering drives reduction in transit cost. So yeah, it looks like they're improving their gross margins, and it's largely constrained by bandwidth, as you know, the amount of data and compute power required by the servers to send their data out to customers. And here they talk about one network with many use cases, increase efficiency and scale. They talk about the different verticals that they operate in: e-commerce, high-tech, fintech, publishing. It's an interesting chart there. Don't know much about. I don't see much use in this one. But now we can look at their capex. So these are large investments, capital purchases, physical assets that depreciate over a year. So their capex as a percentage of revenue most recently was 10%, and their free cash flow, like the video I talked about yesterday, or my last video, was all about how to calculate free cash flow. And here we can see they have a negative cash flow margin for the most recent calendar year. So cash flow from operations minus their capex, so they're cash flow negative. But you can see the trend is increasing slightly over time. They're still in their growth phase. So I don't think it's too abnormal to see a negative cash flow, but that's eventually something that investors want to see as part of their path to profitability. And substantial operating leverage. Here we can see their sales and revenue margins, their research and development margins, and their general and administrative cost margins. So yeah, they're spending a lot on sales and marketing, but it's trending down. They're spending a lot on R&D, and it's trending down, but their general and administrative cost is trending up. And their note says increased operational scale and development of internal processes and general and administration as we went public. So they were hiring a lot more people to help fuel their growth. So that's one lever that's going up. But their sales and marketing, after they hit their go-to-market, is going down. And for R&D, leverage and R&D from meaningful investment in the platform and validation of the product market fit is trending down. So that should all help improve in their path to profitability going forward. And that's the end of their presentation there. And then a few slides later, they have some GAAP to non-GAAP reconciliations, highlighting some of the info we saw before. Here we can see their whole free cash flow from fiscal year 17 to the end of the most recent quarter. And we can see how they calculate free cash flow from operations minus CapEx. So that's a brief overview of FSLY and their most recent presentation. Just to highlight some of what they do, it's a very popular stock that's been getting a lot of attention recently. So I want to talk about the preliminary 3Q 2020 revenue guidance. They did a recent acquisition of a company, I believe, called Signal Sciences, where they had to make some disclosures, and in that disclosure, they were required to pre-announce their Q3 revenue guidance. So they expected third quarter 2020 total revenue of 70 to 71 million, compared to their previous estimates and guidance from the last quarter of 73.5 to 75 million. And this was due to impacts of the uncertain geopolitical environment and the usage of the platform by their largest customer, which is TikTok, did not meet expectations. I'm sure you've heard about TikTok being banned in the U.S. That's one of their largest. That's one of their largest customers, and they use the CDN network to deliver the video content to end users of the cloud computing platform. And just that decreased their revenue expectations for the quarter by a few $1 million, but the stock dropped 30%. So as I touched on earlier, these growth stocks are highly valued by their revenue and sales growth. So they need to exceed expectations every time. Otherwise, there's no GAAP earnings, there's no free cash flow to rely on. So even it may be a small miss, it may be 5 to 7% miss, but that's what this stock is all about, is the growth. There's nothing else of significant value. There's IP, but as far as earnings, cash flows, there's nothing that FSLY can really provide to investors. So they're really looking for that strong and consistent top line growth. And anything that could seem to hinder that is viewed as a huge risk. But I do think it could be seen as an overreaction. So this is kind of a brief overview of FSLY and what they do. Content delivery network. Other companies similar to it are Cloudflare and Akamai that provide these cloud streaming services, security services to other primarily tech companies that operate online and need computing power to deliver to end users in a faster way. So this was a brief overview of FSLY. It's an interesting company, high growth company, and we can continue to follow it and see where it goes, follow their path to profitability and their continued revenue growth and expansion, and see how TikTok affects them going down the road, if they're going to be able to replace that revenue, and just see where it goes. So this is an Investor Blue Book. I'm going to try to find new videos to talk about in the markets. If there's anything that you're interested in seeing below, just type a quick message and I'll be sure to research it and potentially come up with a video. Thanks, guys.